Tesla stock has been on a rollercoaster lately, and no, I don't mean the kind Elon Musk might turn into a theme park. Over just a few trading sessions, TSLA surged more than 22%, then promptly gave back over 7% the next day. This kind of price action might look like classic volatility, but make no mistake, there's a very real and very significant reason behind it: tariffs. Specifically, Donald Trump's new Liberation Day tariff policy, which has sent shockwaves through the global auto sector. Let's break down what's happening, what it means for Tesla shareholders, and why even Wall Street's top analysts are clashing over what comes next. So, here's the recent movement. On April 9th, Tesla stock jumped an eye-popping 22.7%, closing at $272.20. This rally was fueled by news that Trump would implement a temporary 90-day pause on certain reciprocal tariffs. That pause created short-term optimism, with markets breathing a sigh of relief that the worst might be avoided, at least for now. But that rally was short-lived. By April 10th, TSLA had fallen back to $252.40, a drop of roughly 7.3%, as analysts and investors processed the broader implications of the tariff landscape. Markets began asking tough questions, not just about trade policy, but about how sustainable Tesla's current valuation really is in the face of macroeconomic headwinds and competitive pressure. So what's really going on behind the scenes? First, the tariff backdrop. Trump's Liberation Day plan includes a 25% tariff on imported vehicles and auto parts, part of a broader effort to bring supply chains back to American soil. While Tesla produces most of its North American models domestically, the supply chain is still global. Many components, from lithium cells to chips, come from overseas, and tariffs could raise production costs in a meaningful way. Even more concerning is the retaliatory risk. China is one of Tesla's most important markets and also home to its gigafactory in Shanghai. If China imposes counter-tariffs or regulatory friction, it could impact everything from production timelines to vehicle pricing, and eventually, to demand. So while Tesla isn't as exposed to foreign assembly as a company like Audi or Toyota, it's far from immune to the ripple effects of a trade war. Now let's talk analyst sentiment. It's split, and that's putting it mildly. Let's start with Wedbush, one of Tesla's most followed analysts. On April 9th, he slashed his price target on TSLA by 43%, dropping it to $315 per share. His reasoning? Concerns about the new tariffs and, interestingly, Elon Musk's political associations. Ives suggests that Musk's close alignment with Trump may create brand perception issues with more progressive or global consumers, particularly as Tesla transitions from tech darling to mainstream automaker. Next, you've got UBS, which took an even more bearish tone. They downgraded Tesla to a sell rating and cut their price target to just $190, citing a combination of trade disruptions and anticipated earnings revisions. Their core argument? The risks to margins are growing, and Tesla's valuation, even after the recent pullback, doesn't fully account for those pressures. On the more moderate side, Goldman Sachs lowered its target to $260, noting that economic growth is slowing and that the auto sector as a whole is entering a period of margin compression. Their view? Tesla remains a leader, but the road ahead is looking increasingly complicated. So what does this mean for investors like us? First, it's important to acknowledge that Tesla is still a powerhouse in the EV space. It has dominant market share in the US, growing presence in Europe and China, and arguably the strongest brand recognition in the sector. It's also still leading in terms of margin, although that gap has narrowed in recent quarters due to price cuts and increased competition. And let's not forget the innovation pipeline. Tesla continues to push forward with full self-driving, FSD, its new energy products, and developments in AI-driven automation. For long-term bulls, these innovations remain the cornerstone of the Tesla thesis. But short-term? The waters are murky. The stock has become highly reactive to macro news, and that makes sense. It's one of the most widely held names across both institutional and retail portfolios. When markets feel fear, TSLA often gets hit harder. When sentiment improves, it rebounds fast. That's the nature of a high beta, high visibility stock. What we're seeing now is a classic tug-of-war between two narratives. On one side, you've got optimism, Tesla as a resilient innovator with global scale, expanding AI capabilities, and strong demand for its next-generation models. On the other side, you've got real concerns, tariff risks, regulatory pressure, brand image erosion, and increased competition from both Chinese EV makers and legacy automakers jumping into electrification. So, what's the takeaway? If you're already a Tesla shareholder, this might feel like familiar territory. The stock has gone through turbulent phases before. But what makes this period unique is the geopolitical overlay. Tariffs aren't a company-specific problem, they're an external shock that could reshape entire industries. And while Tesla may eventually benefit from a reshored supply chain, that kind of structural shift takes years, not quarters. And in the meantime? Margins may get squeezed. Growth may slow. And headlines will continue to drive the price up or down on a daily basis. Still, for long-term investors, especially those who believe in Tesla's ability to evolve into more than a car company, this kind of volatility may offer opportunity. Just remember, Tesla is no longer the underdog. It's a trillion-dollar company at the center of a very polarized market. That comes with both privilege and pressure. So whether you're holding, trimming, or buying the dip, make sure you're doing it based on your thesis, not the noise. Thanks for listening. If this breakdown helped clarify the current TSLA landscape, consider subscribing for more level-headed market coverage. And let me know in the comments, are you still bullish on Tesla long-term, or are these recent headwinds giving you pause?